I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. We certainly live in interesting times, especially in regards to the financial markets, that's for sure.
Well, we had record highs on some of the equity markets yesterday, and today it looks like they'll probably top that. Is this good news for investors or a warning sign that this can't go on forever, or can it?
Well, first of all, it's certainly taken me by surprise. I was looking at a month ago many of the stocks that have been leading the market this year, the so-called FANG stocks, Facebook, Amazon, Netflix, Google, Microsoft, and there's about 24 more, such as NVIDIA. A lot of them went up huge in May, like 30%. NVIDIA went up 70%. Just that month alone, they had massive rallies. And then on June the 9th, they all had big down days on huge volume. NVIDIA actually had the biggest volume day in its history on June the 9th. But now, here we are a couple weeks later, and this week some of these stocks are breaking out. Facebook is really launching off and going almost parabolic as we're speaking. And so this is really the type of market action you don't see but every 10 or 20 years or something, where you have stocks and the market averages themselves extremely overbought, this deep into rally, and yet they continue higher. In the VIX, which is the volatility index, it's traded just last week. It hit last Friday, to be exact. It hit a low not seen since 1993, a closing low, and that's just an indication there's no fear in the market. There's no volatility. There's only been 2 days in which the S&P's fallen more than 1% in a single day. Normal years, you could have 12 to 20 days like that. Normal 5%, 10% corrections happen periodically over a couple weeks any year in the market. But so far that's not happened this year, and that's given a sense, I think, of people that there's really no risk except the risk of missing out. So it does appear we're seeing a desperate attempt for many people that may have sold or may have been on the sidelines or maybe shorting or whatever the case to scramble this week to start to buy. And I think, yeah, we're breaking out. How much higher we'll go, I really have no way to predict it, but I'm concerned what things might look like in a couple weeks. If we top out sometime before Labor Day, then we'd be facing a correction this fall or even a sizable drop. So I feel good to take money off the table and tell other people to do that and have some cash reserves that they can use later on, because, if you go on margin or take bigger risks here, it's really tough to get yourself in a potential position where when things do pull back, you're not prepared for it, or you're in a position where you can't even handle a single dip or pullback at all, even a 10% correction. So it's just the way markets are. In the end, we all try to predict things and do this and that, but the bottom line is, over time, anyone's results in the market is going to be boiled down to how well they actually manage their money and manage risk and how well they're diversified. And these are principles I'm going to return to time and again because that's what matters in situations like this. And, I'm not talking about someone that's trading, trying to jump in and out of stocks or do short-term options plays and so forth. That's one thing. But I'm mostly concerned about someone who's got their brokerage account as just a regular investor trying to buy and hold, and they're trying to, increase the risks of that. And now it's really not the time to do that. All that said, part of what's making the market go up is last week on Wednesday, there was essentially a bombshell announcement by Janet Yellen when she spoke to the U.S. Congress that I do think is stimulating the markets and will move other asset classes too that people don't have their eye on, and I think that's where the real places to make money are. But what she said is that the Fed is reaching what she called neutral on interest rates. Now, if you go back to December, the Federal Reserve is predicting 4 rate hikes for this year and many additional hikes next year, and Donald Trump had just been elected, and there are predictions for tax cuts, stimulus programs, large economic growth by the end of the year. Now, those things didn't happen, and the economic growth did not accelerate. And as a consequence, long-year bond rates on the 10-year bond, the 5-year bond, the 20-year bond for the Treasury bonds for the U.S. all are lower now than where they started the year at, while the Fed has been raising rates. And that's narrowing the gap between short-term and long-term rates, which is what it means to be neutral if they're on the trading basically this close together. The bottom line is, Janet Yellen talked about this and said that the implication is we can only raise 1 or 2 more times. And she said after that, in the future years we'll raise. But what this means is a rate hike possibly in December, possibly, although I don't think it's very likely, another one. But after that, a very long pause, a year or two, and that pause is then based upon a prediction she makes of higher growth will somehow accelerate way in the future, and then the Fed will resume raising interest rates. But I want to state that that's not the best way to look at that is not as a prediction. No one can really predict what the economy is going to be like 2 years from now, and I think that's more of a hope. That's what she hopes to do, and in reality, any correction in the stock market will cause the Fed to back off on raising interest rates. And she finished her talk. This is all a talk she gave to Congress in testimony last week that if the Fed has to, they'll lower rates. If there's an economic recession or financial turbulence, back down to zero, and then engage in quantitative easing again. So these dovish statements are sort of the backdrop coming into this weekend that is helping the market go up. Now, the best way to benefit from all this, though, is not buying Facebook or Amazon or Google at this point, but buying gold and buying mining stocks, which are consolidating. They've been going sideways for a year, and now we have the Fed reaching the end of this tightening cycle, if not already done so. And I think that's going to add fuel to bringing the final breakout for gold and mining stocks that will spark a really great rally for them. If you look at the GDX gold stock ETF, it has resistance about 23.5. You go through that level, it's taken out. You're going to attack the highs last year, right above 30. It's a nice percentage move. But I think this is really going to be the second leg of a bull market that started last January, ended that first leg started last January, ended in July, and we've been in consolidation. We'll now start the second leg when the GDX goes to 23. And at the same time, I got to tell you, the sentiment is very bearish. It's the complete opposite of the stock market. There's no one interested in gold and mining stocks. I got a big email list and send out emails, and hardly anyone replies. And if you look at the Commitment of Traders report, incredibly, 2 weeks ago, the commercials, who tend to be correct in the futures market, they're the large mining companies, people who hedge, use the future markets for that. They were closing out short contracts and actually buying long contracts, a huge sign that they see price support around 1,200, and they're bullish. And while they're doing that 2 weeks ago, the small speculator who tends to be wrong shorted 5,000 contracts. You got to go all the way back to the end of 2015 to find them going short like that. So the small fry is shorting, the large commercials are going long gold. That kind of tells you everything you need to know. And it hasn't moved yet. Everyone is, for the most part in the United States, is, watching fast money. They're going to chase the Facebook. They're going to chase the Amazon. That's all they talk about now on CNBC, these like 5 stocks. But gold hasn't gone up yet this year. It's in a position to do it. I think that's where people should be putting money to work. And even, if they don't have the cash to do it, sell. Sell some of your holdings into traditional U.S. stock market funds or the ETFs. Get out of SPY a little bit. Sell out 10% if you're fully invested. Move that into GLD. Move that into GDX. And if you want to do even better, buy individual mining stocks. I think that's really the thing that the average person should be doing, taking some money out of the stock market, putting it into gold. So that's what I think people ought to be doing now.
We'll have more with Mike Swanson right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Mike Swanson. Mike Swanson, what do you like better, bullion or gold miners?
Well, they kind of play there's two different roles I think they play. Bullion, if you buy bullion, I own both, so it's not necessarily, I think one is better than the other, but the bullion has less volatility to it, meaning that if it dips, if it falls, it's not going to fall very much. So right now, gold is trading around 1235, and I really think the 1200 level is solid price support. If somehow we're to go through that, I think we're not going to see it go below 1150. I really don't think that would happen. But say it did fall to 1150, that's not much of a percentage loss from here, from 1200. And the reason I don't think it would fall further than that, if it were somehow to go down to 1200, is because the commercials have such a small net short position at this point, while the small fry is trying to short. So from a contrarian standpoint, I really don't even think 1200 is going to break. But I'm just trying to say these are what the risks are. It's not very much of a percentage decline from here. The mining stocks, though, they have greater risk to them. So if there was to be a dip in the stock market even, it's possible that the mining stocks could get hit in a really, violent, if there was a violent stock market correction, whereas gold and silver probably wouldn't fall that much. But over the next couple of years, I do think the mining stocks will go up more than gold and physical silver do, because what happens in mining companies is if the price of gold goes up 100 points, that adds a huge percent return to their earnings growth. It can double just on a move like that. So the mining stocks will go up more, and you can get dividends from mining stocks. So what I do personally is I invest in both and try to mix my risk up having multiple types of asset classes. But if I was someone that had to choose only one or the other, say I had a portfolio and only was going to put 10% into gold or the mining stocks, well, in that case, I would probably just pick the bullion. But that's also assuming I'm not someone who even wants to look at my account or manage it, and just kind of says, well, I'm going to put 10% in gold. I'm going to put X amount in the stock market, X amount in the bonds, and rebalance it once a year. I would just put 10% in bullion, but I'm much more active with my investing and look at it every single day and make changes all the time.
With bullion, of course, there's storage costs. Would you prefer to have the physical product or just certificates?
Well, I don't buy just certificates. The way I do that is I do it in some physical. I have it stored away somewhere, and then instead of certificates, I just use the Central Fund of Canada. It's a fund, trades on the U.S. stock market and the Canadian exchange, that owns both physical gold and physical silver. There's other alternatives. There's a GLD ETF that's real popular in the United States, and Sprott's got an ETF. So there's plenty of instruments you can use with a brokerage account to have physical bullion. So I'd consider just have physical that's real. You can really hold if you want to store it away somewhere safe. And I'm happy just to use these instruments that you can get through any brokerage account, so to have certificates locked up in a drawer somewhere.
We'll have more with Mike Swanson right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're talking with Mike Swanson. Mike, what's your outlook on oil? So many people have predicted its demise, but it still hangs in that upper 40s range, and it's frankly helped the Canadian dollar quite a bit.
Yeah, well, they're both, those are two separate things. The Canadian dollar, I'll talk about that first. I think it's breaking out. It's been in a bear market in regards to the U.S. dollar now for years. It fell below 75 to the U.S. dollar on the exchange rate, but on the charts, it certainly seems to have broken out, formed a double bottom over the years. It looks very bullish, but I think that move is less about what oil is going to do than the fact that the U.S. dollar has been weakening over the past couple months for two reasons. One, the economic growth predictions we came into this year with have not materialized, and they're probably not going to. It's almost the end of the year. No Trump programs. The health care bill is destroyed. So there you go with that, unfortunately. And then at the same time, as I spoke earlier about interest rate policies, we were looking at 4 rate hikes going in this year, and we only got 2. There's only a 40% chance of one in December, so the rates aren't going up as people had thought. And I think that's what's actually weakening the U.S. dollar in vis-a-vis of the Canadian dollar. With oil, I do think that we're actually in a bear market still in oil that started in 2014, and I viewed the rally last year as a counter-trend rally that took place, and two things have happened this year that made me think that. First of all, the oil stocks have been among the worst performing sectors of the entire stock market this year, down almost every single week. Very slow drop, but a drop nonetheless. And it's the XO ETF, the oil stock ETF, is almost down 18% for the year. At the same time, around February, inside the futures market with the Commitment of Traders report, the commercial traders built up the largest net short position they've ever had in history. the last time they had a historic position was in 2014. They even surpassed that. So that tells me that they're bearish. And until they vastly reduce their bearish holdings, I'm not going to get bullish on oil. Now, that doesn't mean oil's got to crash to 20 or fall to some crazy number. But I do think that for the time being, it's bearish. And I like to think of it kind of like where gold was in 2015. Gold had big collapses in the years going into 2015, but that year didn't really fall much more. It basically went sideways, and then finally turned up last year. So I think really that's what oil is doing. It's probably going to test the lows of last year at some point, which would mean going to 30, possibly below it for a short period of time. But I think that would happen with a stock market drop, which I do think can still happen this year. So I'm really interested actually in investing in oil companies that pay great dividends. But I think the turnaround time is still probably next year when that's going to happen.
Mike, thank you so much for talking with us.
Oh, thank you. Great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.